Is an asset you own used in another person's business? Hello, this is Baron Tax and Accounting. If you own an asset such as land, a factory, or even a trademark that someone else uses to operate a small business, you might be eligible for CGT, capital gains tax, small business concessions when you sell the asset. These concessions can either completely eliminate or significantly reduce the capital gain tax you owe on the sale, or at least allow you to defer it. How does this apply? This rule applies in various situations, such as if your asset is used by your spouse or a child under 18 in their own business. If you jointly own a small commercial property with your spouse and your spouse uses it for their business, for example, an art framing shop, photography studio, or accounting firm. If your asset is used by a family company or family trust in which you have a relevant interest. However, the rules may become more complex if you are only a beneficiary of the family trust. In reverse scenarios, where an asset is owned by a family company or family trust and is used in the business of a relevant shareholder or beneficiary, the concessions may still apply. An example would be farmland owned by a family trust and used by a relevant beneficiary. The key factor: leasing versus non-leasing. One of the most important aspects to understand is that these CGT concessions apply whether or not you lease the asset to the business operator. This means that even if the asset is provided for free or there is no formal lease agreement in place, you may still be eligible for the tax benefits. For example, if you own a commercial property and lease it to your spouse's business, the asset may qualify for CGT concessions. If your family trust owns a warehouse that a related family company uses without a formal lease agreement, the CGT concessions can still apply. Testamentary trusts and special cases. Interestingly, the CGT small business concessions may also apply if a testamentary trust continues to operate a business previously run by a deceased person. However, it may be easier to access the concessions if the executor, beneficiary, or surviving spouse sells the business asset within 2 years of the deceased's passing. Who qualifies? These rules allowing an asset owned by one party to qualify for CGT small business concessions when used by another are only valid if the parties are either affiliates or connected entities, as defined under Australian tax law. Determining whether two entities are considered affiliates or connected entities can be complex and depends on the specific circumstances of each case. Seek professional advice. If you think you fall into one of these scenarios, or if you plan to start a small business and use assets owned by someone else, it is crucial to seek professional advice. Proper planning and structuring can help you maximize the CGT benefits available and optimize your overall tax position. Contact us to discuss your situation and ensure you take full advantage of the available concessions.